My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I've been with my friends. I'm just trying to save you some money. My job, not just to entertain, but to educate, teach you about days like today. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. All right, look, we all know the headlines, right? Day with the Dow plunged 809 points. S&P plummeted 2.81%. NASDAQ nosedived 3.95%. Well, let's just say there are tons of bad news. Like, and tons of bad articles, like the one I'm reading right now. USA Today saying, see, market turmoil, fear spikes, stock stall, Wall Street searches for signs. This is the final washout. What are they talking about? The relentless selling has panic investors running. The recap goes on to say the VIX up 23%. The market is starting to price in a lot of bad potential outcomes, such as a recession, some financial crisis. And then investors fear central banks can no longer dampen and backstop the market. Oil prices and a slowdown in China could be signs of a global recession could drag down the U.S. There's just one problem. This isn't today's paper. No. This is a paper from January 21st, 2016. It isn't this slowdown in China. It's that slowdown in China. It's not these high oil prices. It's those low oil prices, $26.55, worried about the industry collapse. And on the day, it wasn't down 565 points. It was down a little bit more because it was 16,000 point basis, not a 33,000 point basis. So while we should be thinking about the size, the number that the Dow dropped, what matters the most is the denominator. And while there are hints that we might be near the end of the panic in that story, the writer paints the picture clearly. It's still too early to say that the market has hit rock bottom, but there are signs panic selling is leading to a stampede out of the market that will eventually clear the way for recovery. End quote. Well, there it is. 2016, now. After today's disappointing Google numbers, the collapse of what was once FANG, the horrendous 20% decline in the NASDAQ for the year, I thought it might be good to offer not a bullish perspective, we don't need a bullish perspective. What we just need is another perspective of what's going on, not from today's paper, but from a paper not that long ago. Because what we keep getting are the same stories over and over again when we have these big sell-offs. Sure enough, back then, the market ultimately held its ground, actually tested that low one more time a month later. And then it went on to have a 10,000-point rally, pretty much in a straight line. Now, I never want to be sanguine about a sell-off, especially this one. The damage is severe, especially in the technology stocks. And there are real reasons for the fear. But just like 2016, where I read you the exact quotes, you have no idea whether we could have a snapback. We know this. There are three culprits behind our decline: the Fed, Russia, and China. Any one of them could put an end to this meltdown, just like what happened 6 years ago. One reason why we got slammed today is earnings. We had a bunch of big international companies that acquitted themselves well in a rough environment, yet the market wasn't buying it. Too hard, because we still haven't seen any signs that the Fed, Russia, or China will change its course. It's funny, back in 2016, China changed its course. Of course, they pumped up their economy. The Fed got a little bit less hawkish. I mean, this is what happens. We're setting it up, just not fast enough for you and me. Now, if you're General Electric, which reported an intensely disliked quarter today, you need to see your supply chain get sorted out, China get better, and end the war in Ukraine. Tall orders. I could say the same thing of 3M. Raytheon might have joined them in the dumpster if they weren't a key arms supplier to Ukraine in a war that keeps intensifying. Yes, the bear case is palpable. The Fed isn't breaking inflation fast enough by just talking. It must act. It should act tomorrow. Can't wait for the next meeting. And it needs to shock the system with a 75 basis point triple rate hike, fully knowing that it won't cause mass unemployment. There are too many job openings as it is. What it would do is help bring down some of these meddlesome material costs that are teetering and need to be pushed over the edge. They can be pushed over the edge. I think it's better for the Fed to get it over with quickly rather than dragging things out like they are. If they hit the brakes in the economy, we'll need less stuff, and that will relieve many of the supply chain bottlenecks I keep hearing about on every conference call I'm on. How about Russia? Every time we think Putin might be willing to ease up, they talk about using nuclear weapons. It's sadly, Dr. Strange, like farcical. A week ago, their feckless foreign minister, Sergei Lavrov, knowing that the Russian army was in retreat from Kyiv, assured us that nukes were off the table. Wow, thank heavens. Today, with the Russian army about to advance in eastern Ukraine, nukes are apparently back on the table from this man to scare us away from sending the Ukrainians much-needed tanks and artillery. Well, I'm glad our leaders are finally calling their bluff. Oh, China. I mean, how long can we be hostage to their economic weakness? 2016, it was all we talked about. It's all we talked about. China's beginning to remind me, frankly, in this, with the way that they're handling the epidemic, they're beginning to remind me of the Lincoln Tunnel scene in Stephen King's seminal work, The Stand, where soldiers on the Jersey side of the Lincoln Tunnel huddled in machine gun nests trying to stop fleeing New Yorkers infected with the novel Captain Trips virus. Of course, they fail. Unlike The Stand, where north of 99% of the infected perish, the number of people who die in the hospital from Omicron after a triple cocktail of Pfizer and Moderna vaccines is remarkably small. Unfortunately, China refuses to use Western-made vaccines, even though they have much better efficacy than their homegrown ones. So the lockdown keeps spreading because it's the only way that they think they can contain the virus. Obviously, it can't. Member to President for Life Xi. You can buy the Mandarin edition of The Stand for $18.89 on Amazon. It'll be there by Wednesday, May 11th, guaranteed. Too late, no doubt, for every city to come down with COVID in China, but act now as there are only 7 copies left. It's a fast read. Now, we don't know what will put an end to the panic. There are lots of people huddled in a few expensive safety stocks. That was a talk of the day with solid dividends. Coca-Cola, PepsiCo, can't blame them. Numbers were great. Others, including my charitable trust, have been buying the oils because some have 7 to 8% dividend yields as long as the price of crude stays anywhere near these levels, which I think it will, bounce again today. Still others are hunting for companies with pricing power, the ones that can put through price increases without losing customers. We happen to have Chipotle tonight. They can do it. A few intrepid souls are buying tons of stocks that haven't been this cheap since 2000, 2008, or the COVID crash of 2020, the tripartite test of ugliness that's been good grounding for a bottom before, because these 3 moments were far more terrifying for the stock market than anything that's happening now. All 3 groups are not making money. However, here is how I look at it. At the moment, we have three tractable, not intractable, but 3 tractable problems. If one of them gets solved, we might find a bottom worth testing a month from now, like we did in 2016. If 2 get solved, we're going to get a massive rally. And, of course, we're in the heart of earnings season, so there are other potential positives. Now, while Alphabet, the parent of Google and YouTube, reported an imperfect quarter after the close thanks to weaker-than-expected YouTube advertising revenue, I think the after-hours sell-off will become to look like an overreaction. Same time, Microsoft reported an excellent quarter, in my view, and nobody wants that now because it's part of FANG. And FANG, what is that? Well, FANG is 4 letters that might as well be one giant scarlet letter. It's untouchable. One thing is for certain, people hate some stocks down 50% from where they love them, something that happens every time we get hit with a huge sell-off. Even as the semiconductors and software names have been bludgeoned, well, I thought beyond all recognition, but I can still give them another whack. Yet I just need to remind you of one thing. Now, if you go take a look at the chart of the Dow Jones Industrial Average over the next 7 years, after that USA Today paper that I read you from, next 7 years, look at this. You'll see that the early 2016 meltdown that was so bad, that was worse on a percentage basis, that scared everybody out, that got people from thinking that you got to get out because it's a bear market. Well, guess what? It's barely noticeable. If you're like me, you probably don't even remember how that darn sell-off even happened, let alone how it ended. Here's the bottom line. We've got 3 big worries in this market, but we've been worrying about them for weeks or months at this point. And I think we need to start preparing ourselves for the possibility that something may actually go right. That's been the usual trajectory of these horrifying sell-offs. I don't know why this one will be any different. Mike in Connecticut. Mike.
Hi, Jim. Booyah!
Good to have some spirited booyah.
I got a question for you. With the only U.S. flag cruise ship getting back into service, NCL's Pride of America, is NCL a buy or sell?
Okay, well, look, I happen to believe that these stocks are buys because we're traveling again. We're hearing this over and over and over again. The problem is we got a lousy market. And in a lousy market, people want to sell anything that's got a lot of debt. And Norwegian Cruise Lines has got a lot of debt. So just understand, take it with a grain of salt. When you have stocks like Alphabet that are down 200 points, people are not looking to be able to get into the market. They're looking to flee the market. Now, maybe they should be looking to get in, but they want to flee. We continue to be worried about the Fed, Russia, and China. But I think it may be time to start preparing ourselves for the possibility that something may actually go right, although it sure doesn't seem like it. On Mad Money tonight, fresh off its Investor Day, could Callaway Golf be in a hole-in-one for investors? I'm checking in with the company's top brass. Then after another tough day for the average, is there an end in sight for the pain? I'm going off the charts to find out. And Chipotle report after the bell. I'm running through the report with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.